Hello, everybody. My name is Paul O'Keefe, and I'm from Aon, and I'm leading Aon's initiatives for energy transition in Asia Pacific, and really how we assist clients promote and achieve their road to net zero plans. I'm also a member of the Energy and Utilities Committee at the British Chamber of Commerce here in Singapore, and it's really my privilege on behalf of the Chamber and my fellow committee members to welcome you all today to this seminar that will discuss ensuring the energy transition. Now, in the face of a lot of increased concern about the sustainability of our sort of economic activity, the impact of climate change, and quite literally the survivability of humans, we're really witnessing really accelerating of ESG trends, the environmental, social, and governance factors such as climate change, transforming technology, and changing sort of socio-demographics, which really will mean the future is likely to look very different than it does today. Now, Mark Carney, the Special Envoy to the United Nations, when referring to climate change specifically, he said, and I'll read it, that by ensuring and investing with foresight, the insurance industry has the opportunity to break the tragedy of the horizon. And perhaps really that's what we can explore today. Can it, does it, will it? Does insurance have some of those keys to really unlock barriers to slowing climate change? And I guess really just for starters, just understanding what those barriers are can really help to lead to the right sort of innovation. And in many respects, with COP26 having taken place in the UK, arguably the home of insurance, not surprisingly, the level of engagement by the insurance community has really never been higher. And I think we can expect to see much more innovation to really come forward from insurers to meet the needs of innovative sort of energy developers. And I'm really delighted to be joined by some key leaders from both. As head of Lloyd's Asia, I'm pleased to introduce Pavlos Spyropoulos, who will really discuss Lloyd's approach to energy transition. Before we turn to underwriter Tom Baker, who leads the renewables business globally at Markel Syndicate, for his insights. And then we're also absolutely delighted to have Alan Core from Cleantech Solar to bring new energy developers sort of perspectives to this group. And all our speakers are based in Singapore, as I am. Now, each will provide more details of themselves and then their companies when we turn the microphone over to them for about a 15-20 minute presentations from each, before we'll then come to a much broader audience Q&A. Now, please don't hesitate to use the chat function as and when questions might come to you, or indeed comments, and I'll endeavour to cover them off when we get to the Q&A session. Can I also really say, this webinar works on Chatham House rules. What I will say is really a lot my own opinion, not necessarily that of Aon, and the same really applies to my colleagues, my panelists with me here today. All right. So really, I think it's my job now to set the scene and bring some, take 10 minutes just to bring some context to the discussion, in the hope that we can really leave the session today having identified some strong key themes and insights. When I talk to clients about the changing energy landscape and the role of insurance, many of them do say to me that it's becoming more difficult really to define sort of risk sharing and to fix contracts, given a lot of uncertainty around the availability of insurance coverage to underwrite the most relevant risks. So there were some questions that I put forward for this webinar for the speakers and you as an audience to think about. Number one, what new risks is the insurance industry seeing from or impacting energy transition? How can insurance become more relevant towards achieving a net zero carbon footprint, will traditional sources of risk transfer continue to be the provider of this critical financial instrument? Or indeed, will we need to see new and innovative schemes being required? And finally, if the insurance industry can't provide risk transfer, how will traditional contract allocation models and project strategies have to be changed to really continue to maintain a value chain, providing reward from acceptable risks for energy transition projects and investments? So what are we talking about when we say energy transition? Why don't I start by thinking about what that means for insurers? And I always like to turn to Petronas. They're an incredible company, always very well organized. And I turn to their website and they say very neatly that for them, it's for their business to firstly reduce hydrocarbon flaring and venting, capture methane emissions, and optimize production and operations. It's also to mitigate greenhouse gas emissions from operations through energy efficiency improvement and capture opportunities in the energy transition segment by accelerating its stepping out strategy into renewables such as solar and hydrogen. And finally, is to minimize waste and promote recycling throughout the value chain. In fact, on the 1st of March, the Star publication Malaysia published that Petronas is going to set up 2 new units later this year with significant capital expenditure at their disposal, one being the cleaner energy solutions business and also the setup of its carbon management unit. So really, in simple terms, we can say there are effectively 2 legs to the energy transition stool. It's about reducing carbon from existing operations or investing in new carbon reduction schemes on the one hand, and they're really about developing new technologies for cleaner energy supplies on the other. And this is the road to net zero. Now, depending on a company and how it's impacted by scope 1 or scope 2 or scope 3 emissions, each company will take on their initiatives at a different pace. And carbon reduction equally is something that has many, many variables and will be done differently, and the approach will be different from many clients. But really, what does then this mean for insurers? We know today that investor initiatives really seek to redirect flows of finance at scale towards achieving better environmental, social, and sustainable outcomes. And as a capital market, insurance is no different. They're equally now reacting, and certainly coverage for the fossil fuel sector looks to diminish. Now, what the Net Zero Insurance Alliance framework, which is sponsored by the United Nations, is urging insurance companies to do is to both focus on shaping their portfolio of insureds to net zero, but also as a capital base to use premiums to invest in green solutions and green investments, what we call responsible investing. So really what we're seeing for existing fossil fuels operations is that many insurance markets, through their own ESG commitments, have something of a negative agenda for the energy sector, denying insurance for companies that don't meet their ESG credentials. And in fact, we've seen some major insurers and reinsurers say they'll no longer support new coal-fired power stations or projects such as oil sands. Now, this can only shrink the insurance market, but really the United Nations framework does suggest that insurers can be flexing around client transition plans and investment needs, and really a lot more work needs to be done. Ultimately, at Aon, we believe the creation of a new renewable, low-carbon and recyclable economy is actually a period of great opportunity and growth, both for our energy clients and insurers. And if you think about it, I picked up something from Wood Mackenzie. They've said that Australia has the potential for a hydrogen market by 2050 that could be worth up to $90 billion. Now, at Aon, our endpoint team do a lot of research and provide perspectives on these sort of new industries, where they're happening, how is it happening, and where and how can insurers sort of participate. But there are some very basic and many challenges for underwriting a new or remodeled science, particularly the lack of data, and within that data, loss history, because underwriters, they have to have a way to really measure the risk, and then the nature of that is to determine its insurability, and of course, the right premium to charge. And if they get that wrong, insurance is not really sustainable for very long. And I think Alan and Tom can reflect more on this in the solar and wind renewable space, which by now has at least 20 years of experience. Now, look, I had a little list here of different things I think we can think about insurance. But given that I'm late to this call today, for which I deeply apologize, I think let me just skip on to that and let's just then talk about some things that I guess brokers such as Aon, where are they seeing energy transition? Briefly, I think that what we're seeing at the moment is brokers really working on producing sort of documented ESG outputs, really by defining climate pathways or online sort of ESG tools for their clients to better articulate their ESG mission and current status. But I think for a lot of insurers, they worry that this is just a way to try and introduce a new credit on the premium for their clients, which I suppose in some respects is the flip side of an underwriting strategy that might look to weed out poorer ESG performers. But overall, not surprisingly, markets are a little uncertain as to where all this is going to go. At Aon, I think, we've got pretty clear direction. Speaking recently at a Bermuda Risk Summit, our president, Eric Anderson, basically said, carbon-intensive businesses need support to transition rather than being abandoned. What he said specifically, and I'll read his quote, in order to decarbonize, we need massive investments in new technology and new resources, both public and private. The capital will require protection, so walking away from carbon-intensive businesses in the short term with no plan to transition will leave a power generation void, particularly in developing countries. We'll also strand that workforce and leave them without family-sustaining wages. Now, with Asia presenting 2/3 of the world's energy demand by 2035, there's obviously a lot for us to do to support a region currently so dependent on coal for its energy needs. Now, what we're doing at Aon is asking how can insurance be redesigned so that in of itself, the insurance product promotes or accelerates energy transition, thereby becoming a positive contribution to the brownest assets, the poorest performing companies, as a carrot, rather than driving transition with a stick by walking away. So the coverage itself really becomes and delivers the right outcomes for our planet and our communities. Now, this will have much greater success for supporting clients and sustainably delivering premium income and maintaining insurance, as opposed to a strategy that simply looks to carve poor ESG corporations out of the scheme. Now, to do this, we really need to be able to work at an asset level, not just a corporate ESG perspective, and develop tools specific to the risk manager and their insurance purpose. Now, this remains a work in progress. But with such thoughts in mind, I now invite our guest speakers to take over the microphone, and perhaps I can kindly ask you, Pavlos, to start, and please reintroduce yourself to kick off your presentation of Lloyd's approach to energy transition. We will then turn the microphone over to Tom to focus more directly on renewable wind and solar energy forms from an underwriter's perspective, before hearing from Alan as a renewables project developer for his perspective as a buyer. Pavlos, over to you.
Thank you very much, Paul. And Oh, I'm a bit of echo. I don't know. Cool. So thank you very much, Paul, for introducing me. Paul, I think, can you mute your microphone? I'm getting a bit of feedback. Thank you. So yeah, thank you so much to Paul and the British Chamber of Commerce and the Energy and Utilities Committee for inviting me to today's event. So just to introduce myself again, my name is Pavlos Spiropoulos and I'm Lloyd's country manager for Singapore and CEO of the Lloyd's Asia platform, which is Lloyd's biggest platform outside of London and effectively provides insurance, specialist insurance to clients all across Asia Pacific. And the reason Paul invited me to join today's panel is to provide you with a high-level view of how the insurance industry is responding to the energy transition. And for those of you who may not be familiar with Lloyd's, it is the world's leading specialist insurance marketplace. And it's not a single insurer, Lloyd's, it's instead a market where over 50 insurers compete and collaborate to underwrite specialist insurance risk. And what makes Lloyd's unique is that all the insurers operating in our market trade under Lloyd's licenses, and all policies issued by Lloyd's underwriters benefit from an additional layer of financial security provided by Lloyd's over and above the regulatory capital that individual insurers are required to hold. So this means that if any single Lloyd's insurer is unable to meet a valid claim, Lloyd's steps in to pay. The reason I wanted to explain our model is that it'll give you a sense of the scale and potential influence Lloyd's has on being able to support the energy transition, particularly as most of the world's leading insurance brands trade through our market. In 2021 alone, Lloyd's were at $48 billion in premium, of which around $3 billion was energy business. This makes Lloyd's a leading provider of energy insurance globally, and so we recognize the role we have to play in energy transition, and ultimately there are three ways we look at this. Firstly, we need to respond to government, regulatory, investor, and customer demand for us to have a clear sustainability agenda against which we can report. And Lloyd's has committed to reach net zero by 2050. Secondly, we need to be able to support our existing customers to transition effectively. And thirdly, we need to play our role in supporting development of more sustainable energy sources. So with this in mind, what I wanted to share with you today are some of the highlights of the ESG commitments that Lloyd's has made. And some of the output of the research that we've done in key sustainable energy sources and what we're encouraging the insurance industry to do to support their development. And finally, what we believe businesses need to be thinking about as they consider developments around the renewable energy landscape. So as today's session is focused on energy transition, I'll not go into our full ESG commitments in detail, which you'll find on this slide and the next slide, which hopefully you'll receive after the session. I'll primarily focus on the energy elements. What I did want to highlight is that the commitments that Lloyd's first published in 2020 and updated last year in 2021 do not bind all our market participants. However, what they do is set a roadmap against which we expect our market to work towards to ensure they operationalize their ESG strategy, policies and processes, including responsible underwriting and investment. In terms of our commitment to sustainable insurance, the key areas of focus are that we expect Lloyd's managing agents to provide no new insurance cover in respect of thermal coal-fired power plants, thermal coal mines, oil sands, or new Arctic exploration activities from the 1st of January 2022. But in order to support Lloyd's customers through the transition, Lloyd's managing agents will be asked not to renew new coverages, I say, for thermal coal-fired power plants, thermal coal mines, oil sands, or new Arctic energy exploration activities after 2030. So effectively, we want to facilitate a transition, and we recognize it will take time, but we do feel we need to be moving in a certain direction. We'll also apply these commitments to companies with business models that derive at least 30% of their revenues from either thermal coal-fired power plants, thermal coal mines, oil sands, or new Arctic energy exploration activities from the 1st of January 2030. Concurrently, we want to make sure that we're playing our role in the development of new and innovative insurance products, for which the Lloyd's market has been known for historically, to support the energy transition, to support resilient infrastructure, and also low carbon economies and more resilient cities and communities. And I'll share with you a little about how we're going about this. So please can we skip to slide 4. So next slide, please. So there are now a number of innovation forums that have been developed across Lloyd's market, focused on increasing products and services available for renewable energy. The traditional oil and gas underwriters at Lloyd's have a great deal of technical knowledge and expertise that can cross over and benefit the risk management and program structuring regarding renewables projects. We also have a renewable energy consortium at Lloyd's in London, and recently launched one here in Singapore, which Tom Baker, who you hear from after me, leads for us. We're also working with energy clients to develop educational events on renewable technologies to drive awareness, engagement, and action from the broader reinsurance industry to support better sustainable energy solutions and to answer questions such as what's the market landscape, what do energy clients need from the insurance industry, and how can these risks be written in practice? We know that over a period of time, oil and gas suppliers will themselves be transitioning, so our duty is to support them in that transition. Finally, in 2021, Lloyd's launched a Centre of Excellence for Systemic Risk, which we called FutureSet, to increase society's understanding of risk and act as a catalyst for industry, government, and societal action to develop new ways of protecting businesses, communities, and economies. Next slide, please. Since its establishment, FutureSet is focused on the subject of energy transition and greener energy, as the insurance industry has a vital role to play in making clients aware of the developments taking place within the energy sector and in helping them to assess how these could impact their business and provide opportunities. This information is available publicly on our website, and we continue to publish new and updated research regularly. But I wanted to share some highlights with you from what we've published so far to give you a sense of the opportunities and challenges we need to consider. Next slide, please. So I'm not going to cover renewable energy, which I have included here for your reference, so you can have this when we hand out the slides, as Tom Baker is going to cover this in some detail and he is the expert. But I will talk to you about energy, about nuclear energy and hydrogen. So next slide, please. So as the second largest source of low carbon energy, nuclear energy now provides around 10% of global electricity supply, generated from around 440 power reactors across 31 countries. Predictions from the 2020 World Energy Outlook suggest electricity generation from nuclear could increase by almost 55% by 2040 in its sustainable development scenario. Nuclear energy provides many developed and developing countries with a reliable source of energy that complements more intermittent renewable energy, which relies on external conditions such as weather. A blend of both nuclear and renewable energy sources therefore enables cities and countries to achieve a stable supply of low carbon power to their electricity grids. Although some skepticism remains as to whether nuclear energy should be a long-term solution, owing to the carbon intensity of the construction and decommissioning of nuclear power plants and the safety of nuclear waste disposal, emissions during the construction period are typically offset between 18 months and 5 years of operation. Over the 60 to 80-year lifespan of a nuclear power plant, it's therefore expected to generate a negative carbon footprint. The next generation of nuclear technology is also being actively explored. For example, the Advanced Reactor Demonstration Program in the US provides initial funding to develop, test, license, and build advanced nuclear reactors. These technologies potentially address several challenges of larger nuclear power plants by reducing upfront capital investment and build time while simultaneously enhancing efficiency and maintaining high levels of safety, standards, and protection. Nuclear applications also extend beyond its direct use as a low carbon energy source. There is a potential future role for nuclear energy in powering the production of green hydrogen, which could act as a key enabler in facilitating decarbonisation across a range of sectors. In addition, nuclear technology has potential applications in the maritime industry through the use of low-carbon nuclear propulsion on ships using liquid-fueled microreactors. While nuclear power generation offers significant benefits in providing low-carbon and consistent energy to the grid, the life cycle of a nuclear project is a costly endeavour, which requires both significant upfront investments to fund the design and construction of a plant, together with the eventual and time-consuming decommissioning of the site once the reactor has reached its useful limit. So owing to the complex, large-scale and catastrophic risks that nuclear projects present, and the fact that the nuclear industry has traditionally been excluded from the mainstream insurance markets of most countries, bespoke coverage is necessary. The global insurance industry has a unique opportunity to further expand the coverage it provides to the nuclear industry, and as global leaders in providing insurance for the nuclear energy sector, Lloyd's will support the increase in nuclear insurance capacity through providing a platform to ensure there is coordinated action between the insurance industry, civil nuclear sector, and government agencies, and to ensure that nuclear operators are able to meet the additional liability required by regulations. Next slide, please. So moving on to hydrogen. Hydrogen is widely used as a low carbon alternative in many industrial applications as a fuel which is burned with oxygen. It can be used in fuel cells, internal combustion engines, and industrial heating processes. Hydrogen use today is mainly dominated by industry. However, its potential uses span across the entire value chain from renewable energy generation through to transportation and homes and buildings. Hydrogen fuel cell technology can be used to power anything that uses electricity, with applications across transportation, such as electric vehicles and aviation, and offers the benefit of higher energy efficiency than traditional combustion engines. Hydrogen can also be blended into existing gas networks to provide power to homes and public buildings. Green hydrogen goes one step further and has an even lower carbon footprint than blue hydrogen. It's produced by splitting water by electrolysis using electricity that's been produced using excess energy from renewable energy sources such as wind and solar. The most critical factor driving the cost of green hydrogen is the price of the renewable energy used as an input. In the first instance, it's likely that the majority of growth in clean hydrogen production will be driven by blue hydrogen until renewable energy achieves sufficient scale to make production of green hydrogen economically viable. In addition, hydrogen can be a leading option for storing renewable energy when converted into a carrier such as ammonia, helping to manage both the variable output from renewables as well as transportation of renewable energy over long distances, such as offshore wind farms. Now, in addition to the cost of any hydrogen transportation infrastructure modification or introduction of hydrogen itself is currently costly to produce. Green hydrogen production costs could fall up to 30% by 2030, according to some projections. However, such a reduction would be dependent on a decline in the cost of renewable energy, an increase in production to benefit from economies of scale, and significant investment to achieve economic viability. The production of low carbon hydrogen is in its early stages, with less than 0.7% of hydrogen production globally clean. There is an expectation that this proportion will grow significantly should national governments achieve the ambitions contained within their respective hydrogen strategies. However, it remains to be seen whether these obstacles to success can be overcome collectively by industry, insurers, and government. The insurance industry can help to de-risk investment into hydrogen infrastructure and incentivize private sector investment. This will ultimately engage the hydrogen community and the hydrogen economy to achieve scale and therefore drive down production costs. This will, however, require long-term government policy framework to give investors the certainty they require, connectivity between individual projects, and a broader infrastructure network to ensure the hydrogen economy can operate across its entire value chain, and a clear risk allocation mechanism between governments, the private sector, and insurance providers where such risks are too great for one stakeholder to carry alone. So next slide, please. So to conclude, what I wanted to share with you were some of the considerations that we think businesses need to make when looking at energy transition. Whether driven by adherence to near-term policy requirements or the desire to improve the green credentials of their businesses, businesses need to be aware of the developments taking place across the renewable energy landscape and how the insurance industry is ready to support them. So we think businesses need to ask themselves, as renewable economies continue to grow, do businesses understand the short, medium, and longer-term impacts this may have on their own business? Are businesses scrutinizing their energy sources and exploring switching to green alternatives where possible? The use of alternative energy sources, especially hydrogen, introduces unique safety implications which will need to be appropriately identified, measured, monitored, and managed. Have businesses considered the approach to these? For businesses operating within the renewable energy economy, do they understand the changing risk profile and subsequent coverage requirements needed at all stages of the value chain? Have businesses ensured there are no coverage gaps as a result of these changes? And have businesses analyzed the risks of not acting to transition to green energy sources? So that's what I wanted to share with you for now. So I'll hand over to Paul and Tom for the next stage.
Yes, let's hand the microphone to you now, Tom. Thank you.
Thank you, Pavlos. Thank you, Paul. As Paul mentioned in his opening comments, I'm Tom Baker. I work for Markel International, and we provide insurance to renewable energy projects. I'm based in Singapore, but in my current role, I lead a team insuring projects globally, and I've been involved in the renewable energy insurance industry for almost 20 years. Can we start the slide, Catherine, please? Next slide, please, Catherine. Most of this webinar will be well aware of the investment going into renewables over the coming decade. I just wanted to translate what that means for the insurance industry in terms of opportunity. Using some headline figures, we're globally looking at tripling of installed capacity by 2030, which will require an estimated $5 trillion investment. To use offshore wind growth as one example, we're currently at almost 40 gigawatts of capacity, which is forecast to be 300 gigawatts by the end of the decade. Now, to put those gigawatts into a bit of insurance context, the metrics we use to measure size in insurance is premium, or GWP, as set out on the table on the right there. Conservatively, as we sit today, the total market for renewable energy is around the $1 billion per annum range. And that's likely to double every 4 to 5 years going forwards. both in terms of annual premium for installed projects and brand new construction projects coming for new insurance. So we're talking very significant growth, which is not seen in many other areas of the insurance market. So this specific part of the energy transition is a huge opportunity, both for my company, for Paul's company, and also Lloyd's with Pavlos. Next slide, please, Katrin. Before I get onto some high-level risk considerations for renewable energy projects, I just wanted to very quickly give you a bit of a background to our experience and the types of projects we insure. We at Markel, and generally the specialty renewable market in London and Singapore, insure large-scale wind and solar projects and portfolios across the world. This ranges from the largest offshore wind project to date, that Dogger Bank, 3.6 gigawatt, $10 billion project, which is currently under construction, to the first utility-scale offshore wind farm in North America. It includes onshore wind farms in Africa and South America, and solar PV and battery storage projects in Australia. My company, Markel, we've been insuring these projects for over 10 years. So hopefully you'll agree it's a pretty broad experience, and we can give a good perspective of how insuring the energy transition has been over the past 10 years or so. Next slide, please. Okay, I think most are aware that wind technology in particular has evolved considerably over the past 20 years. And the image there on the top left just gives you a better idea of the size of the turbines now becoming common in the industry. Offshore wind has seen the most dramatic developments. New projects starting construction this year, for example, in Taiwan, will be installing those 15 megawatt turbines. Now, these are really huge machines, which the Shard and the Eiffel Tower gives you a good idea in terms of scale. They sit almost 300 meters high, and each blade alone is over 100 meters in length. Considering the first two offshore wind projects in the world had a total combined capacity of 12 megawatts, and we're now seeing that exceeded in a single turbine, that really demonstrates how quick that evolution has been. As well as insuring the turbine itself, we as a collective insurance market insure all the cables that link each of the individual turbines you see in the picture there on the bottom left, as well as all the transmission assets taking the power to the grid. That includes the export cables and any on and offshore substations. Now, I've just highlighted there some of the more basic risk considerations we look at when insuring these projects. It's not just what type of turbine and foundation the project is using, but also the experience of the contractors involved, and importantly, in this part of the world, what is the natural catastrophe exposure to the location, and does that country have access to enough of the specialist vessels required to install these really huge turbines? And because of how rapid that technology has been, when we're asked to insure a new project as we sit here today, we're essentially being asked to insure turbines which have never actually operated or even been installed before, in deeper and deeper waters, sometimes using floating foundations. They're further and further offshore with longer and longer power cables, and using installation vessels that sometimes have not even been built yet, and in regions where there's now significant natural catastrophe exposure. So underwriting that risk is extremely challenging. We're taking loads of factors, but a large amount of the unknown. So whilst offshore wind is obviously a hugely growing market and in itself is by no means new, the reality is that the profile of projects we're insuring now are new, and to a certain extent, they're prototypical. Next slide, please, Kate. In terms of actual experience over the past decades, some of the data on this slide makes for a bit of a sobering read from an insurance perspective. Linking back to what I said at the start about the size of the opportunity insuring this part of the energy transition, it does and has come with significant challenges, and this highlights what some of those are. It's based on Markel's data, and whilst it doesn't cover every offshore project built, it is over 80 of them, and it is broadly representative of the industry track record. Now, keep in mind that this is before we've seen any of those really monster turbines installed, and basically all the projects have been in relatively benign European nearshore shallow water locations. These projects have had an average of 4 claims each, which is pretty frequent when compared to other areas of insurance. And again, using that premium metric, clients have paid almost $500 million of premium, but we, as the insurance market, have already paid out more in claims payments. Bear in mind, the premium number will include construction projects which have yet to be completed, and where there is still large claims exposure, you can assume the total claims number will increase significantly. And once you deduct insurer costs, broker costs, other acquisition costs, it's pretty clear that the insurance market has made a considerable loss in insuring offshore wind to date. And that acts as a significant counterweight to the growth opportunity it presents for us. Now, this is not going to be a claims presentation, so I won't go into any detail here, but suffice to say, offshore wind really needs to find a solution to the amount of cables issues suffered across numerous projects, be it export cables or the inter-array cables, installation issues or defects that manifest once it's become operational. Over 3/4 of offshore wind claims to date have been cable related, and nearly every project we have insured has had a cable claim of some description. So when we, as an insurance market, see the extremely ambitious, the extremely impressive Sun Cable project, we also look at a 5,000 kilometre subsea cable crossing multiple jurisdictions and earthquake zones, and it does fill us with a bit of dread, to be completely honest. Next slide, please, Caitlin. On to solar PV projects, and it's a bit of a similar theme in terms of the record over the past 10 years. Whilst the PV technology itself is a lot less of an issue than a wind project, some of the new projects coming to the insurance market now for insurance do bring some challenges. Floating solar opens up a lot of opportunities for certain countries, including here in Singapore and also new projects in Indonesia. And we see an increasing amount of battery energy storage systems, either together with solar projects or standalone. Now, particularly the battery storage projects, they're obviously absolutely critical in accelerating their energy transition, making those wind and solar projects a lot more viable than they maybe have been in the past. But they also add a lot of prototypical equipment into the mix, which can be very challenging to insure. I'm sure some listening will be aware of the considerable challenges the Korean market has had with battery fires, for example. And it is one of the ironies that the expansion of solar PV projects to sort of tackle climate change, that these projects themselves have become the most exposed to the effects of more severe weather. The events highlighted on this slide here are just an example of some of the weather event losses we've seen over the past few years. Now, these are not traditional natural catastrophes in terms of earthquakes or typhoons, the one you may read about in the news, but they also include thunderstorms, and in one instance, a security worker flicking a cigarette causing $35 million worth of wildfire damage to a solar project. And it was a hailstorm in 2019, which has caused the largest single renewable energy insured loss to date, $75 million. Next slide, please. Okay. So just as a bit of a summary as where we are as we look at the next stage of the transition. Like the last decade, as hopefully is relatively clear, the insurance market has lost a considerable amount of money insuring renewable energy projects. To be frank, we've struggled to keep up with the quick evolution of the technology and also the more severe weather patterns we see across the world. To some extent, the projects have benefited from pricing which has not been fully adequate for the risks they've been transferring to the insurance market. As a result, the last few years, the insurance pricing for these projects has increased, and generally the market as a whole has had to tread a lot more cautiously in where and how we provide insurance cover. But as an industry, and as Pavlos highlighted, we also have a lot of focus on ESG and a commitment to offering products that will help our traditional clients, be them oil and gas majors or traditional power clients, to transition to greener forms of energy. Just to finish, the next stage of this transition, we as a market have got to find the balance between supporting those clients and growing in this space, but also being profitable, as no industry can consistently operate at a loss, which effectively it has been over the past decade. And that's all. So on that bright note, I'll pass over to the next speaker, Alan.
Thank you, Tom. And thanks to the rest of the speakers earlier on. So my name is Alan. I'm the VP of Engineering and Chief Technology Officer at Cleantech Solar. For those of you that don't know Cleantech Solar, unfortunately, we are not as well known as Aon or Markel or the rest of the company. So I have to give a quick introduction. So Cleantech Solar, we are founded in roughly around 2015. Our key role is to help our customers, which are corporates, with their energy transition. So as our name shows you, Cleantech Solar, that was the lowest hanging fruit. So that is what we have been driving our customers towards, to install solar on their premises. And in some markets where the regulations allow, we also do off-site solar, where we install a solar farm off-site and channel the electricity to their premises. Cleantech Solar, we are, next slide please. So we are present in 7 countries, India being our biggest market, and we are in Southeast Asia as well. I will not go through the list of countries. We have recently been gone through several M&A. We are now 51% owned by, or will be 51% owned by Capital and 49% owned by Shell. And that helps us have that growth capital, and also shows the commitment by these corporations to speed up the energy transition. Next slide, please. So these are some of the news over the past years. I won't go through too much in detail, but that just happened so. I have to point out I'm the guy who right smack in the middle. I was featured in one of the articles on Straits Times a few years back. Next slide, please. And these are some of our customers that we have helped with the energy transition. And you'll see that they are very, very diverse. We have companies doing textiles, F&B, electronics manufacturing. We have helped logistic companies, auto manufacturers, even cement manufacturing. And we're in various different countries. And that brings about the different types of challenges, which I will cover later on, because of the geography, the industry, and the types of projects. And of interest here, you'll see that unlike some of my other speakers, we kind of do both types of projects. So we have greenfield projects, like the solar farms that you will see. And those are typically a little bit easier from an insurance and execution perspective. The development time is longer, but the execution-wise, the risk and challenges are a little bit less. And we also do a lot of what we call brownfield installations. That means installation on existing buildings. Those then present a different set of challenges, because as you can imagine, it's very different working on a piece of land that is empty versus working on a live factory where they're producing goods underneath. Next slide, please. Yes, and then that will bring me to the main slide that I will be focusing on today, and to give you a little bit more, to elaborate a little bit more on our business model. So we focus on giving our customer the easy experience. So our customers, the idea is that our customers will sit back, relax, and enjoy all the solar benefits, and we take on all the risk. So they only see the tip of the iceberg, and we deal with everything under the water. So this is on the left is one of our customers before solar, and on the right after. We took on all the risk. And with risk, then that comes to the topic for today, the insurance for part of the energy transition. You see that we had to deal with a lot of different risks that as a company, dealing with many different sites, we are actually quite well positioned. But even then, we face challenges. So for instance, if we start from the left, we have technology and performance risk. And on the technology, as Tom mentioned earlier, solar is relatively mature, and not too sophisticated as some people say. It's not rocket science. If you look at the technology, it's quite simple, but there are certain risks that we need to deal with when it comes to technology, specifically on the manufacturing. Most of the efforts for most guys these days, they are focused on the solar panels. There's a lot of scrutiny. We look at the quality, we look at whether the company is going to be around. For those of you who are not in the industry, solar panels typically come with a 25 or 30-year product warranty. However, in my 10 over years in the business, I would say maybe about one third of the companies that I work with have disappeared. So good luck with your 25-year warranty. And to deal with that, the insurance industry has actually evolved, came up with new products. So these days, you can actually get a product warranty policy through the manufacturers. So in case the manufacturer is no longer around, they do have certain coverage for defects. Then as a practitioner, then you have to look at the fine print as with everything. Usually the issue with these policies is the limit. It's a little bit on the low side if they have a serial defect. If the limit is more than enough to cover your projects. However, if you're having that problem, high likelihood many others are having the same problem. And then you have to take the judgment call whether it's worthwhile. And then we have the performance risk as well, where we take on business interruption policies. These days, you can actually get some form of a yield guarantee policy where they can guarantee or rather insure against weather fluctuation. But then you face a different set of challenge where, and I think Tom mentioned it a little bit as well. If you go to different geographies, the coverage will be different. Because naturally, because the risks are slightly different. You have high deductibles, and some policies are simply not available. And then we go on to the project execution risk. This is actually the area that I focus a lot of my time on in the past. So during project execution, typically everyone will get an erection or risk policy and a third-party liability policy. And as I mentioned earlier, these policies are extremely straightforward when you're doing a greenfield plant. It gets quite complicated when you're doing a brownfield because you're working on a live factory or live office underneath. And you have a lot more stakeholders to deal with as well when you're doing a brownfield plant because your clients, their primary objective is to produce whatever they are selling, whereas solar is never at the top of their priority. So you have inherent challenges there. And one of the new challenges that we are seeing specific to insurance is that a lot of our clients' insurers are becoming a lot more hands-on. I think that's a good thing for the industry as a whole. However, a lot of these insurers, they are also not familiar with the local requirements. Let me give you an example. So we work with a lot of US MNCs, and naturally they have a US insurer. And then their US insurer will look at what are the best practices in the USA. So what ends up happening is then they'll be asking us for certain requirements like please comply with the National Electric Code, which is a code that is only applicable in the US. And as practitioners, we find great challenges trying to do so, simply because even if we want to, we can't. We are not able to buy, for instance, inverters that are UL certified that works in Singapore. So these are some of the challenges. And then if we look on the right side of the slide, Cleantech Solar is taking care of the solar power development from A to Z. Then we face different challenges, right? Because we need to do so, we need a lot of flexibility, we need to get the necessary coverage, but it really varies a lot from country to country. For instance, when we started our operations in Cambodia being a relatively new market, I think some insurers don't even have a company, don't even have an office there. So they rely on insurers in Vietnam. So that creates certain challenges when it comes to your policy limits, looking for policy waivers, whether you can secure comprehensive enough coverage. And I think some of our the speakers mentioned earlier as well, natural disaster coverage. So these are all the very real world challenges that we are facing. And then after that, after dealing with all those challenges, then Cleantech Solar has to tie up capital. We have to go out to lenders. And then lenders will have a different set of requirements. They will be looking for consistent coverage across all countries, because that makes it much easier for them to assess the risk and assess the projects. And that is where we have seen that the insurance industry can really drive forward a little bit on this front, having some more consistency in what coverages are available. And lastly, I wanted to speak on a little bit focusing on the developing O&M capabilities. And that is what can we do? Because what are the alternatives to insurance? So at Cleantech Solar, we believe that, of course, you want to pass on some of this risk, to transfer the risk to insurers, but we also need to develop in-house capabilities to mitigate these risks at the source. And that's why, if you look at our slide earlier, we have almost half of our companies are engineers. So we are always looking at how to mitigate this risk at the source, putting in the right incentives for our members to take the right decisions. So I'll give you an example. We focus a lot on the quality assurance process when we purchase our equipment. We look at the equipment selection, manufacturing, and then our own installation and maintenance processes, identifying gaps and making sure that all these are fed back into the loop. So on a whole, I think those are the challenges that we are facing. And the newer challenges that we are facing now, it's a little bit on what Tom has mentioned earlier, which is that now when we are going for renewal, which usually is a yearly affair, we're seeing that the premiums are going up, the coverage is coming down, and that creates a lot of strain for the industry, specifically because some of these requirements are quite mandatory from the lenders as well. So I think that pretty much sums up what I wanted to share today with the entire group. And maybe I'll pass it over to Paul. Q&A.
Thank you so much, Alan. Thank you, Tom and Pavlos, for some revealing chats. Again, I really must apologize. Somehow I managed to lock myself out of my Zoom account and contrived to lose us 15 minutes of this session today. And thankfully, thanks to the speakers for trying to compress things and give us still 25 minutes that we have remaining to ask some questions. If I may sort of kick off, actually, Alan, I mean, if I come straight back to you, you talked a little bit around some of the various attributes to complete development of your solar projects. I mean, what would be your advice to the participants here today as to how could they speed up? How can you speed up your energy transition?
That's a good question, Paul. I think what I've seen over the last 10 years is a lot of people have been holding out. They're hoping that they see that since solar, the price is coming down, let's wait for it to come down further. Or wind is going to become cheaper, let's do it in 10 years' time. So I think the first advice will be don't wait. Prices will come down. It can also go up. The main thing is start early. We all know that climate change is a major problem. Secondly, engage with your stakeholders early. And since we are on an insurance platform today, consult your insurer on what's required, what are their requirements. And once all these requirements are clearly laid out, it's much easier. And lastly, I would say it's always have support from the top. Like it or not, most of corporations are, I won't say top-down driven, but having support from the top helps a lot. And that is where we have seen a lot of problems tend to become non-issues once you have top management support.
Thanks, Alan. Before I let you go, so one of the questions that's been raised actually asks whether the insurance industry believes climate risks are currently mispriced, and if so, what's sort of happening around that? And I will jump to Tom after. But talking to you, I mean, Tom talked about weather events causing significant damage to solar installations. So can I just ask like your thoughts around that? I mean, have you seen insurance, for example, becoming much more expensive because of this risk?
I have seen insurance becoming more expensive, and my impression is because there's been a lot of claims, and Tom did mention it earlier that the industry specifically for renewables doesn't seem to be profitable. And I think from a project developer's perspective, definitely increasing insurance costs, that's not a good thing, but there's also a lot more we can do. For instance, solar is quite a young industry. If you look at it, it's been around for probably 30 years, but most of the developments happened in the last 12, 15 years. And in Asia, in the last 7 years. So everyone is going through this learning curve. And everyone, so I give you an example, like Indonesia is a relatively new market. So they're gonna probably make some of the same mistakes that Germany made 10 years ago. But how can we reduce that? And in doing so, naturally the claims will reduce, and hopefully the premiums will also come down. So I think that is where us as developers, when we scrutinize the technical of each project, we can help to support the energy transition as well.
Thanks, Alan. And turning that over to you, Tom, I mean, the question also asks, is this a sort of local country by country problem or something that the insurance industry is looking at more globally? How would you say you're addressing?
Look, it became, or it started off as a local problem, and as Alan sort of said, a lot of the developments here in Asia are relatively new compared to where we've seen elsewhere. So I can tell you in the US, insuring solar projects for 4 or 5 years, we basically had no losses because they're still quite new. There's not that many of them, and it's only over really the last 5 years where those sort of loss events that have happened. So it's both a growth in, I guess, exposure, just in terms of that severe weather events changing, but also just accumulation of risk. So there won't be that profile of losses here in Asia just because there's not been that many projects. In Vietnam, there are now quite a few, but it's only been over recent years. And just generally on the climate change issue, I mean, you'll know as well as me that the last 5 years, has seen a significant increase in terms of insured natural catastrophe losses. Now, I've got a table which I was going to put in the presentation but removed at the end. Last 5 years, we've seen $450 billion of insured natural catastrophe events. That's 70 events over $1 billion. The 5 years before, that was $200 billion and 40 events. So that's just like an illustration of like how much more an issue it's becoming. And as I said on the solar PV projects, they haven't proven themselves the most resilient when it comes to that sort of severe weather. And I expect we will start seeing that loss profile here in Asia, as we've seen not just in the US, but also now in Europe and the Middle East in terms of weather-related solar losses.
Thank you, Tom. And going to Arijit, who put a question in the chat around cables, and you talked a lot around wind farm developments and issues with cables. We know that Singapore is looking at bringing solar electricity from Australia, and that's thousands of kilometers through a major subsea cable. Could I just ask sort of your initial reactions to that as to what would be the main considerations for you as an underwriter looking at something like that project?
I mentioned that specifically in the presentation in terms of a bit fearful of that project, whilst extremely exciting and ambitious and everything else. A 5,000 kilometer cable does concern the insurance industry. In terms of what we're looking for, it's obviously the experience of the people involved in the project, or the stakeholders, but particularly the cable manufacturer who's doing the installation work. What vessels are they using to do? Have they installed similar cable? Well, they won't install similar cable lengths, but similar cable process, I guess, in terms of delay, and how much is being tested in the factory. But for that specific project, insurance is only going to be a very small part, I think, of the risk transfer that's involved. It's such a size that basically the insurance market cannot take on all of that exposure or potentially not even a considerable part of it. So that will be a very interesting one to see, Paul, when it comes to insurance placement.
Thank you. And then when you talk about scale of insurance, of course, a lot of insurance is provided globally, particularly from the London market. Now, there's a question raised saying that often people feel the Asian insurance markets remain somewhat underdeveloped as compared to other markets. And what's the role, and what is the role of London around this? Are they competing? Are they supporting? And Pavlos, perhaps I could turn that to you with your view from Lloyd's leadership perspective.
Yeah, no, thank you. And I think particularly in my role, I hear that a lot. And there's a lot of discussion around that. There's discussions whether Asia is cheaper than London, whether London's cheaper than Asia, a lot of time on risks and things like that. And is Singapore a threat to London? I think I think London a few years ago did start perceiving Singapore as a threat. Not Singapore specifically as a threat in its own self, but looking at other emerging insurance hubs popping up in other parts of the world, which did pose a challenge to the role of London. So I think there were some entities that did see Singapore as a threat, but I think that perception is changing. And certainly, when I've been in this role, I've been kind of at pains to highlight certainly within the Lloyd's community that Lloyd's in Singapore isn't competing with Lloyd's in London. Lloyd's in Singapore is part of Lloyd's in London. We're international businesses. We particularly in the Lloyd's market, we're underwriting on behalf of the same pool of capital, whether it's written from London or from here. So we're not here to compete with London. What we're here to do is to be closer to clients in the region, which is what people like Aon and the other brokers are telling us clients want. So I wouldn't see it so much as a competition, but rather an evolution. I think the question is, are Asian insurance markets less developed than other markets? A lot of them are. And that's just a natural thing that basically comes from the level of sophistication or advancement of certain economies in the region. But I think it's only natural that as economies here grow, as the center of gravity of the world economy moves towards Asia, you'll have a more sophisticated insurance market here to serve those clients, service those economies. So I think looking at it as a threat is probably the wrong way. I think it's a good challenge for London to think about what its role is and how London continues to evolve and really be a center of innovation for the global insurance market. But in terms of being close to serve clients in regions, I think that's clearly something that clients demand and our distribution partners are demanding. And that's why we're here. And that's why I think Singapore in particular will have an increasingly big role to play in the region as a regional insurance reinsurance hub.
Thanks, Pavlos. And one of the questions that's come through, actually, there's some great comments here, talks about the close relationship between regulatory development and future energy transition pathways. When I think about things like carbon trading, how do the demand side of life is going to require government input. How does insurance support carbon trading? Take hydrogen. I know I have a client who feels the regulators government really need to help to create a domestic retail market for hydrogen to allow that whole supply chain to grow. So I think it's a very important comment around the input and impact of regulators. And the question is really, is the insurance sector playing a proactive or reactive role in this engagement, engaging with regulators to help make things happen? What could you sort of comment to that, please, Pavlos?
Yeah, so the answer there is absolutely. So certainly from a Lloyd's perspective, we are, and I know that other competitors in the market and the big brokers are as well. I think what I would say there is we're not necessarily engaging on specific sectors yet, although we're seeking to. And at this stage, we're trying to engage with governments on the financial services regulatory side and other parts of the governments where possible to encourage collaboration on areas where certain risks might be too big to insure, for example, within the private insurance sector itself. So what are the public-private partnerships that need to be introduced to take on systemic risks or transition risks, and so on. So in terms of that conversation, I'd say there would be different levels of sophistication among regulators. If you're looking at Singapore, it's a very sophisticated regulatory environment here, and I think kudos should go to the government here in Singapore, because they are really taking proactive measures and helping drive industry in the right direction to collaborate across multiple different sectors to drive this agenda forward. Our concern is around having situations where regulators move at different speeds or try and adopt different standards or models. So what we want to do as well, and what we're encouraging regulators to do, is where possible, is to have harmonization in requirements, harmonization in policies, to make it easier for businesses to do the right thing and not have to kind of expend a lot of cost on managing different types of frameworks. So the answer to that is yes, absolutely. I think as a sector, we are being very proactive with regulators. There's a bigger picture at play for us here, and it kind of might be a good segue to one of the questions around climate risk. But one of the things obviously we see in the insurance market beyond energy, although energy is affected as well, of course, is the impact of climate risk. We're very well aware of that as an industry. We have been for a long time, and we're seeing the impact of increased frequency and severity of natural catastrophes. So again, that's another reason why we're very engaged with regulators on all these subjects, to make sure that we're working hand in hand with governments to position things the right way, so we don't end up in a situation where whole industries or risks become uninsurable.
Thanks, Pavlos. And so I'm going to hold on to you just for the last question that's in the Q&A. Because in Asia, as you know, many countries have to have admitted insurances through local insurance companies that then get reinsured out. And of course, so in the context of energy transition, is there a lot of a gap and a lot of difference between what local insurers are trying to provide for their clients and how the reinsurance sector is working? Do you see a tension, or do you see things progressing in that area?
But was that for me, Paul, or for Tom?
Yes, I think Pavlos for yourself, but equally if Tom.
Yeah, so I'll lean on Tom a bit here as well, because I guess in my role I'm not as close to transactions. So what I would say, I guess it is true in this region. Looking at Lloyd's perspective, we don't have as many direct licenses as we would in other parts of the world. So on a facultative reinsurance perspective, I'd say there's quite close alignment between our underwriters and clients on the ground, and they work closely with domestic insurers to help where possible, and basically make it easy for the client to access reinsurance. When you're talking that high level of treaty reinsurance, it's difficult to say. I think a lot of the time those dynamics are very complicated, because they're not looking necessarily purely at what's happening in the energy market. When negotiating a treaty reinsurance contract, there'll be lots of other dynamics at play. There'll be the whole macroeconomic perspective. Things like quantitative easing, for example, can have a very big impact on the reinsurance market. So it is true, sometimes the reinsurance market will be out of step with the insurance market. But my sense is it's not necessarily to do with particular sectors or particular classes of insurance risk. Always, I think sometimes the bigger dynamics plays bigger cycles in the insurance industry. Yeah. Tom?
Thank you. No, that's cool. Thank you. Well, why don't, because we've got 10 minutes left, so maybe we should try and open up the microphone to the audience to see if there are any questions, having dealt with the questions that were in the chat.
There is a question there on whether the insurance industry believes that climate risks are currently mispriced in most markets, and what's the industry doing to fix this, both locally and a more international scale. I think that's something I can pick up on from a kind of Lloyd's perspective, because one of the benefits of being in the Lloyd's market and working for Lloyd's is we get to see incredible data from markets all over the world, and our sense is absolutely we think they are mispriced, and we think that they're not being appropriately priced in a lot of markets around the world. That's not necessarily a bad thing for clients. I think clients have been enjoying beneficial deals really for a long time in the industry, but we do think it's a problem from a kind of sustainability perspective for the insurance industry, because for the industry to function effectively long term, there needs to be an appropriate price paid for the risk being assumed by the carriers. And we do see, this is not necessarily an energy thing, but I'd say across property classes, for example, increasingly we're seeing catastrophe events having a much bigger impact than necessarily priced by the industry. So I think it's something that's definitely on the minds of most carriers in the global insurance industry. And one of the messages Lloyd's has given to the insurance companies in our market around catastrophe risk is to stop basically to stop looking at the increased frequency and severity of natural catastrophes as one-off events that are a surprise, because we're seeing the data's very clear that the new norm is increased frequency and severity. So what we're expecting of underwriters in our market is that they start thinking that way, and they're pricing catastrophe risk appropriately. We're by no means saying we haven't got appetite for it. We very much do have continued risk for catastrophe risk at Lloyd's. That's what we're here to do. But we also just need to make sure we're pricing for it adequately. And we don't think that's necessarily been happening as well as it should be in recent years.
Thank you, Pavlos. If there's no hands being raised, I mean, perhaps Tom, I can come back to you and just more generally around renewables, new energy technologies. Where do you currently see the most or the greatest innovations happening in the insurance industry around these new technologies that are happening?
There's, in terms of innovation in insurance, there's obviously quite a lot of new products that are being designed for this industry. So the products that I give as an underwriter and my company give generally, they're traditional constructional risks, as Alan mentioned, constructional risk, third-party liability, operational risk, and then any revenue lost from it. Some of the more innovative products, I guess, that are being distributed now and being designed specifically for the renewables market includes the type of lack of wind, lack of sun products, which 5-10 years ago were sort of in the market, but not really. But now they're being marketed a lot more widely and a lot more commercially viable, I think for some of our clients. And then specifically on the natural catastrophe risk, in areas where there is quite a lot of exposure and quite a lot of built-up exposure, there's a lot more alternative capacity, ILS capacity coming in, parametric solutions, which maybe will become more relevant. And if I look specifically in my area, offshore wind Taiwan, it's a very big theme here in Asia about how will that natural catastrophe exposure be transferred, and insurance cannot take all of it. So it's going to have to come up with different forms of risk transfer, which include ILS and parametric solutions.
Thanks, Tom. And if we then think, instead of new technologies, think about carbon reduction, like carbon capture, sequestration, or things like nature-based solutions, planting trees. I mean, currently, I don't see a lot of insurance in that area. I mean, I think the issue of accidental release of carbon, greenhouse gases. So if you were trying to for example, keep carbon in a storage reservoir, I mean, I think I'm right here. I mean, at the moment, the insurance industry hasn't got its head around how to provide insurance yet for accidental greenhouse gas emissions. Is that fair to say?
From my perspective, yeah, I think that's pretty fair. You'll probably have a bit of a wider view in terms of the whole insurance market and whether anyone is doing that kind of products. But yeah, I think it's fair to say that it is, as with the other things we mentioned, it's relatively new, and that for insurance is a little bit concerning. And it does take us a while to sort of catch up with what's happening in terms of this quickly evolving space.
And Alan, just to finish turning back to you, I mean, you talked about parental guarantees and product guarantees and so on being really important for your business. I mean, are there other sort of key risks that impact you? And I mean, one of the things we see in insurance is cyber risk. Obviously, is becoming a really difficult risk to underwrite. And when I look at the solar developments and the potential for microgrids with, smart grids and people buying your power through their mobile phones, I mean, is the risk of cyber something that concerns you in what you're doing? So really just general commentary around other key risks that you think about.
Yeah, I think cyber risk is definitely one of the areas that we are looking at. So we are, in fact, in the midst of beefing up our processes and systems as well. I think that's going to be a continuous process for everybody because the risk is greatly evolving. I think, as Tom mentioned earlier, the low wind or low solar irradiation, that's something that's getting a lot more emphasis recently, especially low wind, because we just had a bad year or bad 2 years. So it's everyone's paying attention. For me personally, also as an engineer, what I'm seeing is climate change is resulting in a lot more severe storms, severe natural disasters. And how do we feed that back in? I give you an example. So for instance, in Singapore, maybe we design our structures for like 33 meters per second wind. But then the statistics are going to show that it's not going to be 33. Now, it's 33 today, but it's going to be 50 in the next 5 years. I think that's also one of those challenges that how do we deal with that? And a little bit of a chicken and egg, right? We want to deal with it, but at the same time, it has to be done as an industry, because otherwise we'll be penalizing ourselves. And I see that it's one of the major themes where historical data may not necessarily give you sufficient ability to forecast the future.
Sure, thank you. It's all about uncertainty and bad luck. Okay, we've hit our time. I don't know, Catherine or Helen, if you wish to leave any closing messages before we shut down.
Thanks, Paul. Hi, everybody, and thank you very much for joining us today. Thank you to our speakers and Paul for moderating that fantastic session. There was a lot of detail in there, so if anybody would like to revisit anything, then please do look out on our YouTube channel where the recording will be posted. And please reach out to the Chamber if you would like to know more about becoming a member, or if you'd like to run an event with us yourselves. And on your screen now, you can see some upcoming events that we have in the diary. So just to draw your attention to the 14th of April, what you know to help you to decarbonise your organisation. And then our next in-person event, which is on the 28th of April, which is with a dialogue with Tan Si Leng, Minister for Manpower, followed by the Chamber's AGM. So thank you once again to our speakers for joining us today, and I hope to see you at another event soon.
Thank you very much, Alan. Thank you, Pavlos, Tom, and Alan, and have a good day, everybody.
Thank you.
Thank you, everyone. Bye-bye.